Good afternoon, everyone. Is anyone there? Can you please let me know about the audio video? Is it all okay? So that I can proceed further. Anyone there? Let me know about the audio and video. Done? Okay. Very good. So, very good afternoon. Hope you all are doing good. And today we have started this class a bit late because, as you know, we had the RBI annual report class today, early morning, right? So, I think it takes time to prepare the editorial as well. That's why. Yesterday, the editorial could not happen because I was not well. So, but I went through all the newspapers of yesterday, of today, okay. After going through the newspapers, yesterday all major newspapers like ET, Mint, Business Standard, they didn't have any relevant editorial for you. So I scrutinized them all today. If there would have been any important editorial, I would have taken them into today's analysis, okay. So there was nothing, since you know result has been declared, election result, so most of the editorials are generally political, they are flooded with political analysis and opinion. So that's why there is nothing which you should be worried about. You didn't miss up on anything from yesterday's newspaper, although class couldn't happen, but actually there is nothing, okay, to be taken upon for analysis from yesterday's papers. So today we have this article. Today also from ET and Mint you don't have anything. This has been taken from your Business Standard, okay. So you can go to Business Standard and refer to this editorial. This is very important and directly related to your syllabus. That's why I picked up this editorial, okay. As you can see, and since we have had classes, you must have seen the class on project finance, right? So what is project finance? The draft guidelines issued by the RBI, and this editorial tries to do an analysis of the project finance and what are the prospective responses, what are the responses of the industry, of the banks, of the developers after that guideline, how do they look into it, okay. So this analysis is somewhat like a critical analysis of project finance. So that's why I took up this editorial. This is going to be important for you. Let's begin and try to understand what the author talks about, okay. So as you can see here, that the title is RBI's draft provisions create a flutter. So basically these draft provisions of RBI have created a flutter, okay. People are just not able to grasp whether these are going to benefit them or not. Industry experts, bank experts are in confusion that how is it going to unfold for them, right? So let's understand what is the entire thing, okay. So this is from your Business Standard. Now, first of all, what is it? What is the entire thing, right? So, as you know, in early May this year, RBI had released draft guidelines. So, they have not been implemented yet, but by 15 June, public opinion has been invited by RBI upon these guidelines. So, these are some draft guidelines which are to be implemented. They are not implemented yet. These were released by RBI in May, okay, by early May, which aimed, what was the aim? Aimed at tightening the prudential framework for project financing. Tightening the prudential framework for project financing. Now, there are two terms mentioned here which you need to understand. What is prudential framework and what is project financing? Then only we will be able to understand these guidelines, right? So let's try and understand what is prudential framework and what is project financing. So first of all, prudential framework. Whenever you find this word prudential framework, it is basically a set of guidelines, rules, okay, to improvise on something. So prudential framework here means that the RBI wants this sector, project financing, to be more prudent, to work in a more efficient manner so as to offset the losses and to maximize upon the opportunities. Are you getting this point? So prudential norm or prudential guidelines are guidelines to correct some glitches which are there. More rules and regulations or guidelines to correct the ongoing situation which is somewhat defaulty in its nature. Right? Now, why we have these new prudential framework and more set of guidelines for project financing? Because here there is a problem of NPA, right? What is project financing? Project financing or project finance? What is a project finance? Anyone knows? Will you please let me know? Anyone wants to tell what is project finance? What is project finance or project financing? No answers? Okay. So, see, project finance basically like Basel norms. No, Basel norms are also guidelines, but you cannot compare these two. Okay, they are different. Basel are basically your requirements. These are guidelines. Okay, somewhat different. So when we talk about project finance, funding of long-term projects for capital adequacy. Yes, Basel is for capital adequacy. Funding of long-term projects. Yes, very good attempt. So basically project finance is what? When you have long-term projects, try to understand this. When you have long-term projects, long-term infrastructure related project it can be, long-term industrial projects they can be, right? Particularly long-term infrastructure and industrial projects. But what makes them different from other projects is that for their repayment of the loan, since they are long-term big projects, so you need loan to fund them. Okay, wherever you have raised the money from, wherever you have raised the funds from to fund that project are to be repaid using the cash generated by the project itself. This is the particular definition of project finance. Did you understand this? That the repayment of the loan for that project will be done by the cash generated by project itself. So here the financial options and tools for repayment are very limited. Repayment is based on the working of the project itself. If the project is able to perform well, repayment would be easier and more guarantee of repayment. If the project fails, it might lead to stress on the banking system, on the balance sheet of the banks from where they have taken the loan from. Are you getting this point? So you have understood what is project finance, right? Yes or no? Just quick responses. Yes or no? Project finance, you have understood? So they are basically dependent on the project survival, project which is there, ongoing projects, cash revenue generation to repay the loan, not on some other sources, right? And since this is a big project, long-term project, so the project viability becomes important. What is project viability? That project is able to recover the cost as well as generate additional revenue here, right? So these projects, like big infrastructure related projects, industrial projects, say some related to your highways, expressways, all these projects might fall under this category. Now they have come under the surveillance of RBI. RBI has released new set of guidelines, as you all know, related to project finance. First question, why this is the case? Why they want to more scrutinize all these things? Because as you know, after 2008-9 or since 2010, NPA has been continuously rising in India. NPA is your non-performing asset or the bad loans which are not paid back, okay, or default, the willful defaulters are there. So NPA has been rising continuously, and particularly in these projects. You have heard the names of L&T, all these infrastructure financing companies, right, having stressed assets, haven't you, right? L&T and all. So NPA, the history of NPA for infrastructure and industrial projects, big projects for long term, which are your project finance has not been good. This history has not been good. So to correct this course of trajectory, this trajectory for future time, these guidelines have been issued. Although not implemented yet, these are just draft guidelines, okay. What if any project fails, then they can go for project, that is what we will discuss, okay. They can go to this provisioning which has been provided then. So let's stick to the analysis, then you will get the answer to this question, okay. So this is the thing, this is the overview. To correct the NPA situation, into which infrastructure project has a very huge part in increasing the stress on the balance sheet of the bank, right. This is the thing. Now what are the guidelines? These guidelines propose that banks must set aside 5% of the loan value. Whatever the loan value is to be given to these project finances, long-term industrial infrastructure project, to these projects, the total loan value given, out of that 5% is to be set aside as provision by the banks. This is the main guideline, which has attracted opinions, which has attracted differential opinions. Some are supporting this, some are apprehensive about this, some have a negative opinion or outlook at this, right. So this is the main provision, 5% provisioning out of the total loan value to these kind of projects. Now what does that mean? What do we mean when we say that 5% has to be kept as provisions for infrastructure and commercial real estate projects that are under construction? Remember this. This 5% provision requirement is for the projects related to your infrastructure or real estate, okay, commercial real estate, basically commercial one, but only those projects which are under construction, not for those who have completed their construction process. Are you getting this point? So remember, 5% provision for under construction infrastructure and commercial real estate projects. This thing is clear? First thing, okay. Now what is this provision? What is meant by provision? So when we say 5% as provision out of the total loan value, that means you have to keep 5% aside. Provisioning of loan means you are keeping certain amount of that loan as safe, as reserve, so as to abate any unprecedented situation or default or loss. Are you getting my point? Right? So for example, because these projects are risky. And one more thing, as I told you the definition, that the bank or the borrowers for these loans are dependent on the project revenue generated by the project itself to repay the loan. So that means they are very risky. If the project doesn't work very well, then how will they return the loan, pay back the loan to the banks? Are you getting this point? Given the risk, RBI has proposed these guidelines. Yes, keeping aside for future, basically for security. So as in case there is a default, they can at least cover from that. Is that clear? Now since it is reflective of higher risk, isn't it? These kind of steps are taken when there is higher risk, and you know that in project finance you have higher risk because you are dependent on the function of the on the functioning of the project itself to repay the loan taken for financing the project, isn't it? Yes, they act as buffers, right? So this is the entire thing which I wanted to tell you. So remember, 5% as provision. What is provision? I have explained to you. Future as security, right? For infrastructure and commercial real estate projects which are under construction. Why am I highlighting this again and again? Because there are separate provisions. Once the project has started working, same provision does not apply, 5%, okay? We will discuss it later. It is just for those who are under construction, because project is very much risky when it is under construction. It has not started working yet. You cannot assess the risk before it has started working. So there is a higher risk, isn't it? When it starts working, it starts generating revenue, then only you can assess that okay, it is going to be viable or not. But before it has started earning, there is a higher risk. That's why 5% of total loan amount as provision for projects under construction. I think this entire picture is clear now. Right? Now moving ahead regarding the analysis. This is significantly higher. So the author has compared this provisioning of 5% as significantly higher, which earlier used to be as compared to the earlier provisions, than the current rates, or which are there at the current, which stand at 1% for commercial real estate loans, 0.75% for residential projects, not the commercial one, right, and 0.40% only for other types of loans, which include your project finance category type of loans only. So this is way higher than these. These are not more than 1% even, right? And this is direct 5%. That shows that RBI doesn't want more stress on the balance sheet of the banking system and the financial institutes due to these kind of projects, isn't it? Also at the same time, we do not want to compromise with the infrastructure development. We want them to perform well, as we want our banks to be protected. Are you getting this point? Right? So this entire picture till this point is clear, I hope so. Moving ahead. Okay. Then the digging further into the provisions, 5% is for those who are under construction, right? As projects move to operational status, it finally enters the operational phase, that it has started operating. In that case, provisions can be scaled down to say 2.5%. It can be scaled down to half of it, 2.5% of the funded outstanding, with further reduction to 1% under specific condition. So when the project is under construction, it is 5%. When it started operations, it has started operating, 2.5% can be there. So it can be reduced further, because then you will be able to assess the risk. Are you getting this point? Once you assess the risk, and once the project is generating good amount of revenue, that can be reduced to 1%. That can be reduced to 1% once the project starts performing good, starts generating revenue. Is that clear to everyone? Right? Now, one more thing, that this provision is for all existing projects as well as which are forthcoming, the future projects. Right? So both for the existing ones as well as for the forthcoming projects. Right? Now, moreover, what exaggerates this situation, this analysis, we are just trying to understand what is happening, then we will do the analysis. One more thing highlighted by the author here is that moreover, banks are now mandated to classify loans as non-performing if projects exceed a 6-month delay of completion. 6-month delay of completion from the original deadline. So this is adding more to the situation. This is adding more to the situation. What is it adding to? First thing, you have this tight provision norm. Okay, 5% you have to set aside. That means the funds available, funds with the banking system will get affected, isn't it? Now, to keep aside 5%, they need to earn more out of the loans. They means banks. Banks need to earn more to keep 5% aside, isn't it? To earn more, they will increase the interest rates, isn't it? So when you are assessing higher risk, that would automatically translate into higher interest rates. This is something which we all know by now, right? Higher the risk involved in the loan, higher will be the interest rate. Always remember. And longer the period of the loan, higher will be the risk and higher will be the interest rate. Right? First thing. So this is the first thing. Interest rates will be higher. Moreover, the RBI requires the banks now to classify these projects as NPA if they delay the completion period of 6 months. Okay, if they exceed a 6-month delay of completion. So if they exceed more than 6 months as delay in completion of these projects, banks are required to directly classify them into NPA, not even in SMA or some other accounts, okay, special mention accounts or all these things. No, directly NPA. Do you understand the gravity of this situation? Directly classifying into NPA results into corrupting of the balance sheet of the bank. Now this is your asset which is not performing well, and when bank's balance sheet gets corrupted, RBI again has eye on that bank as well. So banks are also worried, isn't it? Understood? So this is the thing which is there till this point, right? Now, given all these things, what are the responses of banks? So we will look into now responses from the different stakeholders in the economy, right? First, bankers are voicing grave concerns. Some of the bankers are raising their concerns regarding the negative impacts of this. Some are looking at it as, something which will give negative impact on these projects as well as on the bank's balance sheet. Why? Let's see. Negative impact of this 5% provisioning rule, and are worried that it could significantly dampen lending enthusiasm by cascading into higher interest rates. As I told you that since such higher risks are suspected by RBI, that's why 5% provision guideline has been given. So given that case, interest rates will rise definitely. Given interest rates, people will tend to take lesser loans since cost of borrowing will increase. Stringent guidelines, right? Also another provision that if you delay the completion by 6 months, directly classified into NPA. So that's how it would haunt the borrowers as well, isn't it? First you have to pay higher interest rate, next you have to make it operationalize within 6 months, otherwise that would be categorized as NPA. That is a very huge burden on the developer as well, developer of the project, isn't it? Agree or not? So banks say that lending enthusiasm in the industry, among the banks, among the financial institutes, will fall down suddenly. It will affect the demand for loans as well. It will affect the demand for loans as well for these projects. Agree or not? Right? This is the thing. Then the banks say, some of the banks are saying that such higher interest rates could inflate project costs. Some banks are also saying that, these higher interest rates can also increase project cost. Of course, since you borrow to fund the project, your cost of borrowing is higher, your cost of project is higher automatically. You are paying very much interest, very high interest to fund that project, to run that project, right? And render many ventures financially unsustainable. So many of the projects can at the end become unsustainable. So you have 5% provisioning, at the same time you have 6-month time to make it operational, right? In that case, that is a huge burden on the developer. This is the concern raised by the banks, which RBI needs to address, isn't it? Do you think it is a problem? It can create a problem if it is not, right? It can create, right? Yes or no? You are able to understand everything, right? Okay. So this is the thing. Now, so this is the concern raised by the banks. Amidst all these apprehensions, there is an overarching worry about stifling infrastructure investment growth just as the capex cycle is gaining momentum. So here you can relate this point to today's RBI annual report only, where we have seen that government is continuously expanding its capital expenditure, isn't it? Capital outlay in India is increasing by center as well as by the state. Given that increase, isn't it something which would be less incentivizing for infrastructure growth? So that can be a contrast which we can compare to, right? This is also a concern. This can affect the capital expenditure cycle, capital outlay, or the benefits which are to accrue out of this. It can reduce those benefits, the author is saying. I am not saying, okay. This is the thing so far. Now, other concerns which are there. So there are certain concerns raised by the banks. What are certain other concerns which are there? You can see that developers are also struggling. Developers, you know that these big projects have developers, right? So those developers are also concerned. They will be very confused, very concerned, because their money is also at stake, right? Developers are struggling with their own set of worries regarding funding sustainability. How will they raise funding for this? Banks will increase interest rates. They have to keep provision of 5%, so they have to increase interest rate. If they are not able to make it operationalize within the time limit, their project will be termed as NPA. In that case, they will fall under different insolvency and bankruptcy resolution process of RBI. So they are worried about all these things. Are you getting my point? Right? This could lead to increased construction finance cost for developers, eventually trickling down to buyers. One more concern of the developer is, since the cost of construction for developer increases, cost for the buyer also increases. If someone has to buy that commercial property, that cost which the developer had to incur will be transferred to the buyer, isn't it? Yes or no? So that would affect not the developers, not the financiers, not the bankers and industry, also the common man's pocket or the investor's pocket for that purpose, who want to invest in these commercial real estate. Common men, investors, etc. Are you able to understand this? Right? Then RBI says, not RBI, author says, then why RBI has done this? Because RBI has reasons to do it for betterment of all these stakeholders. What are those reasons? Nevertheless, it would be useful to try and understand RBI's concern. We need to understand the RBI's concern as well. RBI's concern as well, right? The specter of NPAs, non-performing assets, over the last 2 decades has loomed large. You know, NPA is a problem which has loomed large over India since 20 years, past 20 years, 2 decades or even more, isn't it? Casting a shadow over the financial health of both the lenders and the borrowers. So these rising NPA have led to stress for the lenders as well, the banking system, the financial market, as well as the borrowers. Like serious rise in NPA post 2008-9 due to widespread defaults on infrastructure projects. So particularly infrastructure projects only have contributed to this rise in NPA, severe rise in NPA post 2008-9. So that's why RBI is targeting these infrastructure projects or project finances. Are you getting this point? Right? This is the backdrop why RBI tries to do this thing. Okay. Then these NPA or this situation was exaggerated by well-documented twin balance sheet problem wherein both banks and companies grappled with financial stress, posed a historic challenge to India's banking system. as you all know, when Arun Jaitley ji were there, okay, so when they were the finance minister, you know that these people worked very hard to resolve this problem of NPA. The IBC was launched, Insolvency and Bankruptcy Code, to deal with these things, right? RBI has restructured some of these schemes, replaced some of these schemes for NPA restructuring, isn't it? So all this was exaggerated by something called as twin balance sheet problem, and that was very much in highlights in 2018, I think so, 17-18, okay, 18 particularly. We don't want India to grapple again with this kind of problem, with the twin balance sheet problem. What is twin balance sheet problem? Although I have explained it in some of the class, but I don't remember in which one. Let me explain it again to you so that you can understand the twin balance sheet problem as well. What is twin balance sheet problem? You know what is a balance sheet, okay? So twin balance sheet problem, where two balance sheets get corrupted, okay? So first we have banks, any bank, and then we have a company, okay? So we have bank A and say company X, right? So there is a balance sheet of this bank where we have assets and liabilities, right? Then we have balance sheet of the company where we have the assets and liabilities. Now you all know what are assets and liabilities, right? For banks, you know that loans are the assets and deposits are the liabilities. For banks, you know that loans are the assets and deposits are the liabilities, right? Because loans are earning for the bank, they are making them earn, and deposit is their liability. They have to pay back the principal plus the interest amount to the depositor, isn't it? Now what happens is, suppose this is an infrastructure company, a project finance company gets defaulted, suppose, okay, gets defaulted, and suppose this asset gets corrupted, then say negative assets, okay, they are running short of their funds, their assets to repay the loan, for example, and their liability has increased for that matter, okay. So this company is say running into insolvency phase, not having funds, not having liquidity to repay their loan, to meet their daily finances or short-term finances. Getting my point? So the balance sheet of this company gets corrupted, asset reducing, liability increasing. First thing, this balance sheet gets corrupted. Now when this company has taken loan from say bank A, okay, for this project, will not be able to pay back the loan. So the asset gets reduced, because loan was asset for this bank, loan given to this company was asset for this bank, and when this asset gets corrupted, the balance sheet of bank A also gets corrupted. This is how twin balance sheet problem arise. Simultaneously, balance sheet of the borrower and the lender gets corrupted. Have you understood this? Yes or no? Twin balance sheet problem. Anyone, can you please let me know? So this is your twin balance sheet problem, okay? I hope you have understood this. Now we don't want to repeat this problem again with India, okay? Then thus strict monitoring of NPA is required, and as you see, the trend past 2 decades, past 10 years particularly, has been they are very strict about NPA. They are monitoring NPA very strictly, be on part of the government, be on part of the central bank, right? Because we want to safeguard the stability and integrity of our banking system. Entire economy's health depends on this, right? So this is the thing. Have you understood the picture till this point? Yes or no? Are you able to understand this? Okay. I assume that you are able to comprehend all these things. I am assuming. That's why I am proceeding further, okay. So now what are the overall responses? What are the overall responses? So these are the background things happening. We have seen the bank's concerns, we have seen developers' concerns, we have seen RBI's concern, and we have seen the need for the economy. We have seen the importance of this guideline for the economy, right? Comparing to the past trends. Now, what are the overall responses if we talk about? Some are positive towards this trend, these draft guidelines, okay? Like the Power Finance Corporation, after examining the draft norms, has suggested that these would have no impact on the profitability of the business and the bank. So, you know, the Finance Ministry has had meetings with the industry experts, bank experts, right? So, there are discussions going on and there are several opinions being generated. One of them, Power Finance Corporation has suggested it would not reduce the profitability of anyone. It's their opinion, right? But others have raised grave concerns like Finance Industry Development Council. Finance Industry Development Council is your representative for your non-banking financial companies. Okay, so Finance Industry Development Council, which represents the NBFCs, has raised issues with the draft plan and plans to write a very strong letter to RBI regarding this. So they are taking this in a negative manner. Okay, while some officials have emphasized that one size fits for all approach is wrong. So some are saying that we are not denying that the guidelines are not necessary or they are not prudent, they will not have a positive impact, no. But we are also not denying the fact that they can have a negative ripple effect. So one size fits for all kind of thing is not welcome as per them. We need to find a way in between, okay, so that the projects do not get stressed as well as the banking system gets enough liquidity and not rising NPAs. Clear? So they want a way in between, neither black nor white, something grey. Okay. All right. If we talk about the infrastructure financing market, all financiers, lenders who are there, who are lending their funds to the infrastructure projects, they are also very confused with these draft provisions. Okay, particularly if you see one of the largest banks and banks which has international branches as well, as you know, SBI, State Bank of India, it has started reacting to this. That's why people are very concerned. What SBI started to do is, SBI has started altering its future loan agreements according to this guideline. They have started altering their agreements, future loan agreements, okay, to cope up with the potential impact of this proposal if gets implemented on project financing. SBI has also introduced a new clause allowing it to pass through any additional cost. So see, you have to keep 5% as provision. That would require additional cost to you, right? Otherwise you could have lended extra fund to someone else and earn interest over it. So that cost, they are planning to transfer this cost, okay, to the borrower, which means that they are looking forward to these guidelines. They are accepting that these guidelines will not be changed. So this possibly signals an expectation that RBI may not significantly relax these norms, rather implement them as it is. So that is just a suspicion, okay. So this is the thing. These SBI actions are triggering these debates, because one of the largest banks of India, and that too public sector, is responding in such a way, has created all these confusions. Getting this point, okay? So this is the overall responses which we are getting. Now the author says, balance, this title I have chosen, balance between financial health and the health expenses. We all want a good health, isn't it? Physical health, mental health, emotional health. We all want a good health. But to have a good health, you have to have healthy expenses, isn't it? If your health expenses are not good enough, their health is not maintained, your emotional, mental, every health is going to destroy it, because we all are worried about expenses, about finances, isn't it? So here the author is saying that the RBI ponders over the feedback on its draft guidelines. As in, when the RBI considers all these feedbacks which are going on, it will have to strike a delicate balance between safeguarding the financial health of the banking system as well as giving a productive environment, conducive environment to these projects for sustainable growth. Are you getting this point? So author highlights at the end that we need to find a way in between. We cannot improve banking sector's health on verge of deteriorating, say, health or increasing the stress on infrastructure projects. Like, you cannot improve your health on the verge of deteriorating expenses. You need to have a balance between health and health expenses, isn't it? Are you getting this point? Anyone? So this is the thing. Now what I want to tell you is, you also need to have this opinion. You should not choose extremities, right? That there should be a balance. Let's see what the RBI decides further. There should be a balance between these two extremities. We have to balance the banking liquidity as well, and we have to balance out the financial health of these project finances or the infrastructure and industrial projects as well. Right? Agree or not? Not getting any responses for so long. All right. Anyway, so this was the analysis. Since project finance is very important for you, a very important topic directly for your examination, these kind of analysis, you have understood how much concerns are there, how it can affect the economy, the banking health, the health of the infrastructure projects, right? So this was the analysis. I hope it was useful for you. This was the conclusion, and keep on revising these things, keep on brainstorming about these issues. It would be helpful for you in your future examinations, right? I hope it was useful for you. Thank you for staying tuned and staying focused. I'll see you in the next sessions. Thank you. Till then, have a very great day. Okay.